Welcome to the Retirement Classroom. Before we dive in, I've put together a free Roth conversion planning guide that covers everything we'll discuss today, including the exact tax bracket tables and IRMAA thresholds you need. You'll find the link at theiretirementclassroom.manus.space and in the description below. This content is for educational purposes only and should not be considered individual financial guidance. Everyone's situation is different. Please consult with qualified financial and tax professionals before making any conversion decisions. Here's something most pre-retirees never think about. If you have $1 million in a traditional IRA, you don't actually have $1 million. The IRS owns somewhere between $200,000 and $370,000 of that money. You just haven't paid the bill yet. Every dollar in that account is going to be taxed as ordinary income the moment you take it out. And starting at age 73 or 75, the IRS will force you to take it out whether you want to or not. Those are required minimum distributions. But here's what keeps me up at night as an educator. Most people don't realize there's a legal strategy that could save them $100,000 or more in lifetime taxes. It's called a Roth conversion ladder. And if you're between 55 and 70 years old right now, you are sitting in the most valuable tax planning window of your entire life. Let's make sure everyone understands what a Roth conversion actually is, because it's different from a Roth contribution. A Roth contribution is when you put new money into a Roth IRA directly. There are income limits on that. In 2026, if you're married filing jointly and earn more than $252,000, you can't contribute directly to a Roth at all. A Roth conversion is something entirely different. It's when you take money that's already sitting in a traditional IRA or a 401k and move it into a Roth IRA. There is no income limit on conversions. None. You could earn $5 million a year and still convert. There's also no annual cap on how much you can convert. You could convert $10,000 or $10 million in a single year. The catch? You pay income tax on whatever amount you convert in the year you convert it. That's the trade-off. You're volunteering to pay taxes now at today's rates so that every dollar of growth in that Roth account is tax-free forever. No taxes when it grows, no taxes when you withdraw it, and no required minimum distributions forcing you to take it out. Now, here's where the strategy gets powerful. Most people have a window of time between when they stop working and when required minimum distributions begin. Under Secure 2.0, if you were born in 1960 or later, RMDs don't start until age 75. That means if you retire at 63, you have roughly 12 years before the IRS forces money out of your traditional accounts. Financial planners call these the gap years, and they are the single most valuable tax planning opportunity you will ever have. Why? Because during these years, your taxable income drops dramatically. No more salary, no more W-2 income. If you're delaying Social Security to 70, you might have almost zero taxable income for several years. Your tax brackets are artificially low. And that's exactly when you want to be doing Roth conversions. You're converting money at 12 or 22% that would otherwise be taxed at 24 or 32% when RMDs force it out later. That spread is where the $100,000 savings comes from. Let's look at the actual 2026 tax bracket so you can see the math. These rates were made permanent by the One Big Beautiful Bill Act signed in July 2025. For a married couple filing jointly, the 10% bracket covers the first $24,800 of taxable income. The 12% bracket runs from there to $101,000. The 22% bracket extends from $101,000 to $211,400. And then you hit the 24% bracket, which goes up to $403,550. Now here's the key insight. Taxable income means income after your standard deduction. For a married couple in 2026, the standard deduction is $32,200. So, if a married couple with no other income converts $215,000, their taxable income is $215,000 minus $32,200, which equals $182,800. That puts them solidly in the 22% bracket. Their effective tax rate on that entire conversion is only about 15%. That's the power of bracket filling. But tax brackets aren't the only thing you need to watch. There's a hidden cost that trips up even smart planners, IRMAA. That stands for Income-Related Monthly Adjustment Amount, and it's basically a surcharge on your Medicare premiums. In 2026, if your modified adjusted gross income exceeds $218,000 as a married couple, you get hit with higher Medicare Part B and Part D premiums. And here's what makes IRMAA especially dangerous. It's a cliff, not a slope. If your income is $218,000, you pay the base Part B premium of $202.90 per month. But if your income is $218,001, Just $1 over, you jump to $284.10 per month. That's an extra $81.20 per month per person. For a married couple, that's nearly $2,000 per year in extra Medicare premiums triggered by a single dollar of income. And here's the other trap. IRMAA uses a 2-year look back. A Roth conversion you do in 2026 affects your Medicare premiums in 2028. So you need to plan 2 years ahead. Now, 2026 also introduced something brand new that works in your favor. The One Big Beautiful Bill Act created an additional deduction of up to $6,000 for taxpayers aged 65 and older. This is on top of the standard deduction. For a married couple where both spouses are 65 or older, that's up to $12,000 in extra deductions, bringing your total deduction to $44,200. But there's a catch. This senior deduction phases out between $150,000 and $250,000 of modified adjusted gross income for married couples. So if you're doing Roth conversions that push your income above $150,000, you start losing this deduction. In the phase-out range, it effectively adds about 6% to your marginal tax rate on top of your bracket rate. This matters for conversion planning. If you're 65 or older, you might want to keep your total income below $150,000 to preserve the full senior deduction. Or, if you're going to blow past it anyway, at least be aware of the true cost. Let me show you exactly how this works with a real example. Meet Mark and Lisa Anderson. Mark is 63, Lisa is 61. They're married, filing jointly. They have $1.2 million combined in traditional IRA and 401k accounts. Lisa does some part-time consulting that brings in about $12,000 a year. They're both delaying Social Security until 70. Their advisor recommends converting $200,000 per year. Here's their 2026 tax math. $12,000 from consulting plus $200,000 conversion equals $212,000 in gross income. Subtract the $32,200 standard deduction, and their taxable income is $179,800. The federal tax on that is about $31,900 for an effective rate of just 15.1%. Their Magi is $212,000, which is safely below the $218,000 IRMAA threshold. No Medicare surcharge. Over 5 years, they convert just over $1 million at an average effective rate of about 16.5%. Total tax paid roughly $168,000. Now let's see what happens if the Andersons do nothing. They skip conversions entirely and let that $1.2 million sit in their traditional accounts. At age 75, when Mark hits RMD age, their combined balance has grown to roughly $1.5 million, assuming modest growth. Their first year RMD would be around $61,000. Add Social Security benefits of roughly $70,000 combined, and they're looking at over $130,000 in taxable income every single year. That pushes them into the 22 to 24% bracket. But it gets worse. RMDs increase every year as the divisor shrinks. By age 85, they could be pulling out over $90,000 in RMDs alone. Combined with Social Security, they're solidly in the 24% bracket with possible IRMAA surcharges. Over their lifetimes, the estimated total tax bill without conversion is between $285,000 and $340,000. Compare that to the $168,000 they'd pay with the conversion ladder. The Andersons save between $117,000 and $172,000. That's not a rounding error. That's a house payment. That's a grandchild's college fund. That's the difference between comfortable and stressed. But you can also do this wrong. Let me tell you about Tom. He's 64, single with $900,000 in his traditional IRA and a $25,000 pension. Tom heard about Roth conversions and got excited. He wanted to get it done fast, so he converted $350,000 in a single year. His total income, $375,000. After the $16,100 standard deduction, his taxable income was $358,900. That pushed him all the way up into the 35% bracket. His federal tax bill, $87,652 for an effective rate of 23.4%. And because his Magi was $375,000, he triggered IRMAA Tier 3. That's an extra $324 per month in Medicare premiums. $3,888 per year, starting 2 years later. If Tom had instead spread that same $350,000 over 4 years at about $87,500 per year, each year's taxable income would have been roughly $96,500, keeping him in the 22% bracket. 4-year total tax, about $67,000. Tom's impatience cost him an extra $20,000 in federal tax, plus nearly $4,000 in annual Medicare surcharges. The lesson is clear. A Roth conversion ladder is not a sprint. It's a marathon. Before you start converting, there are two rules you absolutely must understand. First, the 5-year rules. There are actually two of them. Rule 1, each Roth conversion has its own 5-year holding period before the converted principal can be withdrawn penalty-free if you're under 59.5. But if you're already past 59.5, which most of our audience is, this rule doesn't apply to you. Rule 2, Roth earnings are only tax-free after your Roth account has been open for 5 years and you're over 59.5. This means if you've never had a Roth IRA, open one now, even with just $100. Get that 5-year clock started. The second critical rule is the pro rata rule. When you convert money from a traditional IRA to a Roth, the IRS looks at all of your traditional IRAs combined, including SEP IRAs and simple IRAs, as one big pool. If some of that money is pre-tax and some is after-tax, you can't cherry-pick the after-tax money to convert. The IRS makes you convert a proportional mix. And critically, they use your December 31st balance, not the balance on the day you convert. One strategy. If you have a current employer 401k, you may be able to roll your pre-tax IRA money into that plan, isolating any after-tax contributions for a cleaner conversion. So here's your action plan. 3 steps to start your Roth conversion ladder this year. Step 1, calculate your conversion capacity. Take the top of your target tax bracket. For most married couples, that's $211,400 for the 22% bracket. Subtract your standard deduction of $32,200 and subtract any other income like Social Security, pensions, or part-time work. What's left is your conversion capacity. For the Andersons, that was about $200,000. Step 2, check the IRMAA ceiling. Your total MAJI, which includes the conversion, needs to stay below $218,000 for married couples to avoid Medicare surcharges. If your conversion capacity from step 1 puts you over that threshold, dial it back. A few $1,000s in lower conversions this year can save you $2,000 in Medicare premiums 2 years from now. Step 3, open a Roth IRA today if you don't already have one. Even if you're not ready to convert yet, opening the account starts the 5-year earnings clock. You can fund it with as little as $50. Then call your tax advisor and map out a multi-year conversion schedule. Every year you wait is a year of conversion capacity you can never get back. The Roth conversion ladder is one of the most powerful legal tax strategies available to pre-retirees today. With Secure 2.0 giving you until age 75 before RMDs begin, you may have a decade or more to systematically move your retirement savings into a tax-free account. But this window doesn't last forever. Every year you wait is a year of low-bracket conversion space you lose permanently. I've put together a free Roth conversion planning guide with the exact 2026 tax brackets, IRMAA thresholds, and a worksheet to calculate your personal conversion capacity. You'll find it at theirtirement.classroom.manus.space and in the description below. If this video helped you understand Roth conversions better, please hit that subscribe button and the notification bell. We publish new retirement planning deep dives every week. Next week, we're covering the Medicare enrollment mistakes that cost retirees thousands. You won't want to miss it. Until then, this is the Retirement Classroom. Plan smart, retire confident.